Welcome to Cheques and Balances. I'm Michael Vincent. This is James Blair. And this week we've got our special guest, Matthew Harris from Lighthouse Accounting on the line. He's going to run us through the new property tax changes.
Thank you for joining us this week. Michael, last week I said there were things that make me very happy in the morning. My morning coffee, fan or listener questions. I must add another one, which is one of our favorite guests joining us, the one and only Matthew Harris.
Thanks, Jimmy. Good to be back on your podcast. You know I love it. Anytime I get my name up in lights makes me happy as well.
And I know it was very controversial when we had Higgs join us a few weeks ago. So I'm glad we've kind of smoothed through those bumps and I've got you back on board.
Yeah, does he still work for us? I can't remember.
Formerly known as Higgs, yeah.
Yeah. So Matt, all the way back in March, there was this discussion, there was this surprise around, hey, the investor game is changing in the property world. We'll give you some indications of what might happen, and then we'll think about it and come back to you whenever we bloody feel like it. They've actually come back to us. So the government has come back and said, here is how the new property tax changes are intended to work. Although I know the first thing you're going to say to me, Matt, is it's not law yet. So we thought we'd have Matt join us this week to give us a run through around the rules. Who are the winners? Who are the losers? Are there any surprises? And just break it down as we go.
Yeah, look, and you did right. It isn't law yet. So I like most property investors and property professionals in New Zealand, we're pretty happy to see that they stuck to their word. And we have, pretty much an outline of how the rules are going to apply now in a supplementary orders paper. They have said they apply from 1 October, so pretty much in effect now. They aren't complete. They have to go through the select committee process. Given that this government has a majority, I can't see how it's not going to get through that process and pass into law, but I do think there will be some changes along the way. I think probably let's start by just recapping what was proposed and what's actually come in. Yep. So, and obviously, I think we've had a couple of comments on the show about the new rules, so long-time listeners won't be too surprised. But in short, the government has removed interest deductibility from in-situ properties, but they have retained interest deductibility on new builds. The big question was, what is a new build, and how long will that exemption apply? So the government's now come out and they've confirmed that a new build will be anything with a code compliance certificate issued after 27 March 2020. So that there is one of the surprises without jumping ahead too quickly. That's a year earlier than people expected. Having said that, there was quite a lot of lobbying of the government to go backwards more than 1 year, up to 5 years, to see if the interest deductibility could be retained for basically new build properties that aren't very old. So if you have a new build with a code compliance issued after that 27 March 2020 date, you will be able to deduct interest, and that period will last for 20 years. Quite a pleasing period of time. In the discussion papers, 10, 15, 20 years was mentioned. 20 years was mentioned the most, so no surprise to see that there. One of the good things about that is actually it's going to pass from owner to owner. So if I buy a new build today, I hold it for 10 years, I then sell it, the new owner is going to get the additional 10 years of interest deductibility. Yeah. So pretty good. I guess I've been thinking a little bit lately about leasehold land. Yeah. When you buy leasehold land, obviously the closer it gets to the end of its lease period, the less desirable it becomes. And I do wonder whether new builds will become less desirable as they get closer to the end of the deductibility period.
Yeah. I think, and I guess that's a really important point just around the change of ownership during that 20-year period for people who are also looking at perhaps shifting something from a trust to a look-through company or a look-through company to personal or something like that, because potentially that was that could have been a bit of an issue if that wasn't in there.
Yeah, so the other thing that has happened, so I might as well keep going through the rules and we can have a bit more of a discussion about it. So what they've also said is that if you increase housing stock, so you put a relocatable on or a modular house, or pretty much convert anything into additional housing with a co-compliance certificate issued, then that will be treated as a new build as well. Yep. And also be able to deduct interest. Now, I think it's pretty clever that the government has used the co-compliance certificate as the watermark for a new build, because you can imagine the trouble they would have had if council wasn't involved, because obviously the council will regulate quite carefully what a dwelling actually is, and a co-compliance certificate won't be issued unless the building's done right, it's done to healthy home spec, and it's actually a dwelling. So I think that's quite clever from the government. Rollover relief has been confirmed. So this is quite an important part of the rules. So people might remember prior to October 2015, there was no bright line. We had the overriding intention-based regime, which still actually applies. Your intention when you purchase the property will dictate how it's taxed, but now we have the bright line that goes over the top. Originally, when it came in, it was 2 years. Then it was 5 years, and now it's 5 years for new builds as confirmed, and it's 10 years for in situs. So what the government acknowledges is that flexibility can become an issue. So they have proposed rollover relief, or they've enacted rollover relief. It's fairly narrow, but the best, there's two parts to it. What appears to be the most opportunity for property investors is the ability to transfer to a trust, where the owner of the property before is one of the primary settlers and also a beneficiary. I think that's going to be quite important, probably for in situ investors more than new build investors, and that's because in situ investors are going to be in that very undesirable position where they're going to get bracket creep as their taxable income from the property increases due to the lack of interest deduction, but their actual cash flow reduces. Yeah. So they're not only they're going to get the bumped into another tax bracket, but they're going to have less money to pay it. So being able to transfer to something like a trust structure and pay 33% as a maximum tax rate will be quite desirable. The second part of it is a transfer from an individual to an LTC. I don't see this to be as applicable, because if you're an individual owner, you can only go into an individually owned look-through company. So obviously there's not a huge amount of flexibility to be gained from doing that. Yeah. It would be better if you could bring your wife in, for example, or your significant other. But nevertheless, that relief is within the rules. So there's only one final thing that I think, well, there's actually two final things. Boarding houses and Airbnbs have been left out of the clear definitions of what will be interest deductible. However, I don't think that conversation's over yet. What the rules are saying is that if you provide accommodation in a residential dwelling, then you will not be able to claim interest. Hotels, motels, etc. are exempt from the rules, and that's on the basis that they are what's referred to as a commercial dwelling. Yeah. Now, it's going to be interesting to see whether the government follow the same definition of a commercial dwelling, which is currently used for GST purposes, which includes boarding houses or similar, so Airbnbs by default. And I think we'll find as the rules become clearer that if you are a GST registered boarding house or GST registered Airbnb, you're a commercial dwelling and you'll still be able to claim interest. But if you're just a mum and dad with a holiday home that you Airbnb sometimes, then you won't be able to. I expect that to become clearer as we go through the select committee.
Yeah, and that's pretty common for a lot of people out there, especially with rentals and prime beachside locations, is that a lot of it is Airbnb these days. And you know, I mean, I guess outside of COVID, but even inside of COVID, you still get a pretty good return from an Airbnb over those summer months when it's been rented out. So a lot of customers will be looking at that and seeing what's the impact and what they can do.
Yeah, definitely.
Mm.
Definitely.
So, Matt, this has been quite a long time coming. There's quite a lot of changes in there and a lot to digest, which one of the things that kind of emphasizes to me is I need a good accountant more than ever. But yeah, like always, the accountants win when there's a change.
Yes, definitely.
Is this what we expected?
I think it is. I think it is what we expected. You know my opinion. The show knows my opinion. I think the rules are fundamentally wrong. I think that they are unjust and they adversely affect mum and dad investors. And I think what they fail to recognise is that the New Zealand rental or investment property owners provide a huge amount of accommodation in New Zealand at a far lower cost than the government can. So the big surprise, which highlights this perfectly, is that if you provide a property to a social housing provider, Kāinga Ora, or some other registered social housing provider, you are able to deduct interest still, and not just for 20 years, forever. And that is the big surprise. And that more than anything shows me that they're pushing in the wrong direction. And you know why that's come in? Because the government has made tenancy laws so uncommercial in New Zealand that most landlords have given up trying to provide accommodation to anyone who's on the fringes, because they got rid of the 90-day no cause tenancy termination, which basically allowed people having trouble. And remember, 90 days is a long time for people not to pay rent. You know, it wasn't some arbitrary thing that landlords can go, you're out. But it stopped you having to go to the tenancy tribunal and carry on, and you basically just get rid of really bad tenants. Now, those tenants aren't getting picked up. Not only that, investors, in lieu of the interest deductibility changes, have gone through their portfolio and gone, okay, well, I'm going to get rid of some in situs and I'm going to redeploy capital into a new build. The in situs that more than often they're going to get rid of are the ones with the tenants in them that they don't like. They can sell that property. That's an easy out to get those tenants out, and they redeploy the capital. So the government's going, oh shit, we can't get enough houses. And I think anyone who reads the news knows that the government's spending a huge amount of money at the moment on emergency housing and hotels, and that is a direct result of their own policies. So I look at this social housing thing and I go, well, buyer beware, or caveat emptor. I don't think it is a golden egg. I think that there'll be circumstances where that will work for investors, but also dealing with those organisations. Usually they have long leases. You know, there's a lot to it. It's not the same as just renting a house to an individual.
That's a really interesting observation, Matt, around why that's been introduced, that they've been kind of, you know, the fringe and those that are maybe, I don't know what the right word is, but not the most desirable tenant, potentially, probably not the right term to use, but have suffered from these changes. And I can think of at least half a dozen examples where, in my opinion, landlords have gone with quite reasonable things to the tenancy tribunal and just lost, because the tenancy tribunal is so lopsided now. And you can understand where they're trying to come from, where they're trying to protect the person who's more vulnerable, less control. But I mean, one person that's given an example is where somebody is urinated on the floor, and the tenancy tribunal has turned around and gone, hey, where is your proof? Like, I can't tell by these pictures that there's any urine. Where is your proof? And it's like, well, if you go in the house, it's going to smell, and that's going to be pretty obvious. But just an example, I've got some own personal examples where just trying to be like a reasonable person getting things done is quite complex. And you're right, it's the hardest it's ever been to be a reasonable landlord and expect reasonable things from tenants.
And I asked the question is, what happens if the government makes it so unattractive to be a private landlord that private landlords stop doing it?
I mean, the bottom line is the government needs private landlords. Like I've seen something on one of the Au Pairs podcasts before, where they allude to buy all of the housing in New Zealand like all the private housing in New Zealand is like so many times their annual spending. It's ridiculous. There's no way they could buy up all of the housing. So they need private landlords, and it needs to be something that's commercially viable to do, right?
Yeah.
Yeah, absolutely.
I guess the point there is, if they were to buy up all the or if the price dropped out of the bottom of the market and everyone could afford a house, all of a sudden we've solved the housing price crisis that we don't really want to solve, all things considered, because all of a sudden everyone's in a lot of trouble. So what I might do, Matt, is we'll turn the conversation a little bit just towards, let's say I'm an investor, and I think I know what the answer is going to be already, but let's say I'm a property investor. Let's say it's my first time getting into the investment market. I'm like, I don't know what all these rules mean. I've just got an owner-occupied house. Let's say I've got an accountant on board to run me through all that, but what would your advice be? Where should these people be looking to get onto that investment ladder?
Yeah, look, that's a difficult question because you all know that everything's client specific. But in general, if you are a first time property investor, then probably now you are going to be looking at new builds. And that's the cash flow profile is going to be drastically different.
Yeah.
And I think that the problem with that is that new builds obviously now are very, very desirable. And property investors with in situ properties will be looking to buy new builds to balance their portfolio, or they'll be selling some properties and buying new builds. So I think it's going to depend on whether you are someone who has high personal earnings, because if you have high personal earnings, an in situ property is probably going to give you a greater return over time, but you're going to have to swallow the cash flow.
Yeah.
And that, I've said it before on this show, and I'm not the only person out there saying it, rents are going to rise. They're already on the rise. The government's made it quite difficult for landlords to raise rents now, but nevertheless, you can still do it once a year. And I expect that the rents will rise over time to offset the interest deduction, and the in situ market will continue on strongly.
Matt, when you say rents will rise and the government's also made it more difficult to increase rents, can you just expand a little bit on why rents are going to rise, and then also what the government has done to make it more difficult?
Yeah, so I think let's start with what the government has done. Over the last year, the government has made sweeping changes to the Residential Tenancies Act. Not many of those changes have been welcomed by landlords, surprisingly, and not because landlords are unreasonable people, just because the rules themselves make it very, very difficult for landlords to deal with tenants. And make it very difficult to deal with the property in a commercial way, so raise rents in response to market conditions. And a cynical person would say, well, the government knew what they were going to do as a third step, and so they passed the tenancy rules first, and then obviously they removed interest deductibility. So, see what you want in that, but it looks to be quite clear that they've actually lined it up in that manner. So what will happen in a free market theoretically is that as the costs of providing a service increase, the rates charged to the consumer increase. So we'll be in a situation where the first people to move will be those with good advice. So if you're our client and you're talking to me about this, I'm recommending that everyone start raising the rents now. Interest deductibility on situ properties is getting phased out over the next 3 years, but start raising them now. Then the second lot of people who raise rents will be those who just simply can't afford to pay the tax bill that's associated with it. Because remembering, you take the interest deduction away, but they still incurred the interest. So you're going to have quite negative cash flow for a lot of people. They won't be able to afford it. They have to raise the rents. Then the third part of it will be the market doing what markets do. As the rents start to rise from those first two groups, it will just spill out into the wider market, because the new higher average rent will have already occurred. So when properties get re-tenanted, annual reviews, things like that, they'll just happen. And I think the fourth bit, which is obvious at the moment, is inflation. Theoretically, inflation should just push rents up without doing anything, and inflation is running quite a bit higher than it should be at the moment.
Right. Now that's a really good explanation. I think something important to to run through around the logic behind rents increasing, but fundamentally costs increase. We're seeing what's happening in the world around inflation as well. It doesn't take a scientist to work out what's going to happen.
We don't even need a resident economist in our podcast. Sorry,
Ed. So Matt, on you spoke about new builds a little bit and why they will become more attractive going forward. Obviously, the interest deductibility is a huge tick in the right direction. What are the other benefits of playing in the new build space?
Yeah, I think new builds have always had benefits for certain types of investors. You can lock in a property at today's prices, and theoretically, in a rising market, you should have made capital gain before you settle without actually having to add any value yourself. They're generally easy to rent. They're in locations quite often that are desirable, so they're usually smaller houses but closer to the city. Low maintenance, so there's no maintenance, and a big one is that they require a lower loan to value ratio than in situ properties. And I don't know, Mike, is it easier to borrow for a new build sometimes?
Yeah, well, the loan to value ratio instantly means it's easier to borrow for them. There's a little bit more process just because you're waiting for the house. So sometimes it's a little bit easier to get the house now rather than wait 12 months to get the new build property. But banks are so used to this now that it's no harder, really. You know what I mean? There's a little bit of waiting, there's a little bit more process, but borrowing for a new build is as easy as borrowing for an in situ. Once you take the LVR rules into place, into account, it's significantly easier for your average investor to get that new build than it is to get the in situ. And I know I'm jumping in with the mortgage broker chat here, but I'm gonna chuck it in and just think about it on a returns basis. You are putting in a deposit, let's say 10%. Let's say you put in 100 grand. You are not paying any mortgage for 12 months, and you are going to get capital gains on that house for 12 months. You know, you're not getting capital gains on 100 grand. If you're putting in a 10% deposit, you're getting capital gains on $1 million property for 12 months while you're not even paying the mortgage. I just cannot stress how good that period is when you're getting those returns. So yeah, it's I'll stop the mortgage broker chat now, but yeah.
But it's true. Yeah, we all know that the higher the leverage, the higher the rate of return. And you know, there's situations where high leverage is not safe. But a new build, it probably is not one of those situations most of the time.
Yeah. Mike, if I can just encourage the mortgage broker chat for a second, can you just run us back through what does LVR mean, and then in addition to what does LVR mean, you mentioned like a lower LVR for new builds. So what is the LVR required for a new build versus a existing property?
Yeah, no problem. So an LVR, or a loan to value ratio, is the amount of loan you can take out compared to the value of the house. So generally speaking, you'll see 20% throw around quite a bit. Banks want you to have a 20% or an 80% loan to value ratio. So a minimum of 20% deposit and 80% is the loan. You know, not many people in first home buyers have 20% now. Usually it's a 10% deposit they'll have, so a 90% loan to value ratio. Different types of property have different loan to value ratios attached to them. The big one that we're talking about here is an in situ investment or an existing investment property versus a new build investment property. For an existing in situ investment property, you will need a 40% deposit. So for $1 million investment property, if it's existing, you'll need a $400,000 deposit. So a 60% loan to value ratio. That's quite prohibitive to a lot of people. And, you know, you do use equity in these sorts of things, but the numbers are the same. You're still going to need that equity from somewhere, or that deposit from somewhere. For a new build investment property, so like Matt said before, with the CCC that's been issued after that date, you're going to need a 10% deposit. So, you know, that is a significant difference, right? If I need a $100,000 deposit for a $1 million property versus a $400,000 deposit for $1 million property, that is a significant difference in your purchasing power and how much and what type of property you should buy. So that's really quickly what the LVR rules are, and sort of how they come into play with the investment properties.
Mike,
and of note, sorry, James, just one other thing that you left out, Mike, was really important. Generally, an in situ property is quite a bit more expensive than a new build property in the same area.
Yeah, and so Matt touched on this just before. New build properties, usually a townhouse, so you're going to have less land. Still be 2-3 bedrooms, something like that. There's a little bit less land that goes with the property. If you buy that in situ house, it's going to have a lot more land on it usually. Maybe a front yard, a backyard, something like that. So you're going to pay for that land, even though realistically speaking, you're not really utilizing it or getting the rent from it, because you're still just renting out a 2 or 3 bedroom house. So that's why you can sort of get a property that is in a better location for a better price with a new build.
Mike, you mentioned 10%. I just want to check for new build investment properties. Do we need a 10% deposit or a 20% deposit?
So it depends what bank you're with, but you can get as low as 10% for a new build investment property.
That's crazy. Matt, before we wrap up, is there any way that with these changes, investment property owners or new investment property owners can get the edge, or maybe other things they consider when they're deciding how to invest?
Yeah, talk to a specialist property accountant.
Plug.
No, look, I think that you're going to have to look at your personal situation and decide what type of investor you're going to be to begin with. So you're a capital growth investor or you're a cash flow investor, or do you want to mix of both? Then outside of that, you now have to decide whether you're an in situ investor or you are a new build investor, and work it out from there. I think that obviously, if you're going to buy an in situ property and there's an opportunity to add a dwelling to it, that's going to be more desirable than otherwise. Otherwise, if you're going to be buying new builds, then they become desirable just by the fact that they have interest deductibility. I think what we're going to find over time is lots of creative ways to get interest deductibility going to pop out of the woodwork. And I think that one of probably the key things will be converting minor dwellings, adding minor dwellings, converting garages to dwellings and getting co-compliance. And I really hope that the government makes the council consenting process easier, because we're going to expect to see a huge amount more consenting and things like that going on. So already the council's notoriously slow, and it's not very easy to consent a property in New Zealand. So I hope that the government sees this and says, well, let's make it more streamlined for minor dwellings, for example, or something like that.
Yeah, absolutely. And then if you're thinking about how does this apply to my own situation, like Matt said, the fundamentals are still there. What kind of property investor do you want to be? Do you want to be very hands-on, kind of delegate it to a property manager, lower maintenance? Are you looking for opportunities? You need to think about how this fits into your life, your financial plan, how you want to invest your time. We will wrap it up there. Matthew, thank you very much for joining us. An exceptional job, like always.
Pleasure. Thank you for having me.
Before we let you go, please make sure to subscribe on YouTube, hit us with a like, and if you're on Apple Podcasts, make sure to give us a review so we can help spread the word and get more people to take control of their financial future. We'll see you again next week.
Cheers.
Awesome. Cheers.